Let's save that like that. We are off and running. Good morning, everybody. Welcome to today's session, as you can see, with our friends from MUM, Manchester Underwriting Management. Very kindly presented by Megan Jones, who's a senior PI underwriter with them. Megan's going to take us through the market and about claims. Just got a couple of bits of housekeeping, if you don't mind. Questions, Q&A box, as always. We'll hold them till the end. Also, this session is going to be a little bit interactive with Megan, asking you guys a couple of questions. So in the chat box, if you can answer to everybody, Megan will be able to see your answers up as you respond. So that's enough from me. Thank you, Megan. Thanks for putting the session on. Really grateful, and I'll chat with you later.
Perfect. Thank you, Neil. Thanks, you for the introduction. So yeah, as he kindly introduced, I'm Megan Jones, a senior underwriter with Manchester Underwriting Management, or as I will probably refer to as throughout the presentation, MUM. Just less of a mouthful. And I'm here today to talk to you about insurance brokers, E&O, or professional indemnity insurance, as it's probably more commonly known in the market, and where claims come from. MUM are a partner of BIBA, and we've been working with them closely over the last couple of years. And we now insure a large proportion of BIBA members and also a large proportion of insurance brokers throughout the UK market. So hopefully I am well placed to sit here and speak with you today. To kick off then, my slides are just running a little bit slow. Hopefully the agenda should come on now. There we are. First hurdle overcome. So yeah, so the presentation, as I say, will hopefully be an insightful one and give you some insight into what's going on in the market, particular areas that could potentially impact insurance brokers and their own E&O insurance. The presentation will fit quite neatly into two halves. So the first part, I'll look at the market context, some factors that could potentially cause challenges for insurance brokers at this time, and some helpful risk management tools, techniques and questions to ask yourselves on how to overcome these issues. And the second part, we'll be looking at claims data and particular specific claims examples that we at MUM have helped insurance brokers with over the last couple of years. And as Neil said, there'll be plenty of time for Q&A at the end. So if you want to ask your questions in the chat box, if you don't mind it being public, then ask to everyone. If you want to keep it anonymous, then just make sure you send those questions directly to Neil. And as this is a structured CPD webinar, we have some learning objectives here. Don't worry about taking note of them at this moment in time, because the slides and the presentation recording will all be available after the session today, so you can probably copy and paste them. But just to run through them, we're going to be looking at a number of market factors currently impacting insurance brokers, key considerations and risk management procedures that all insurance brokers need to have in place or should consider having in place. Then move on to look at the types of claims that insurance brokers can have and their causation. And finally, just going to spend a few moments talking through anticipated future threats and what can be done to get ahead of them. So just a little bit of a thought to the future there. So to kick off, market summary. So using the chat box, if you can please. Can anybody hazard a guess at how many insurance brokers there currently are in the UK market? I'll open up the chat box so I can see your response. 5,000. Thank you, Nicola. Good start. Any advances on 5,000? 3,000, Leslie. Thank you. We're getting very specific. 2,500. Perfect. Wow, 12,500. Yeah, some good guesses there, and a lot of you were in the right ballpark. So as of today, there are approximately 2,500 insurance brokers in the UK. This figure doesn't include appointed representatives or life agents, so some of those higher guesses probably we count for those. And I suppose the first question is, why would a consumer or a business look to an insurance broker to place their policies for them? So the crux of it is, it's probably where their insurance needs are a little bit less straightforward, or there's potentially something a little bit niche about their insurance requirements, and they need that extra level of guidance and advice. Insurance brokers are deemed to be skilled professionals, so this is important when it comes to looking at insurance brokers from an E&O perspective. They are regulated by the Financial Conduct Authority. A crucial part of their role is to truly understand the needs of their clients and place cover that satisfies those needs. As the insurance market as a whole has been experienced over the last couple of years, there's been quite a few disruptions. We've kind of gone through and are just coming out the end of a hard market cycle. There's been a pandemic in the form of COVID-19, which is probably new to something that insurance brokers haven't had to weather before. There's also been new regulation in the market over the last couple of years. So what I'm going to touch on now on the next slide is these market changes and the new regulation could mean for a broker's exposure in business, and how that could potentially give rise to claims. So, market outlook. I just want to pre-frame this slide and state that it's not all doom and gloom in the insurance market, but for the purpose of this presentation, I'm focused around claims. I am focusing on areas where this could go wrong and challenges that could give rise to a claim. So the first point I want to cover off here is consolidation. Quite simply put, consolidation is where one business acquires another, or two or more businesses acquire to become one entity. So again, please, used in the chat box, can anybody think of any negatives or any potential challenges of consolidation and what this could mean for an insurance broker? Give you a few minutes just to type down your thoughts. Just practices, professional indemnity exposure, yeah. So yeah, so just looking at the professional, like, different systems, different approaches, legacy issues, PI exposure, yeah, absolutely all of those things. And that's kind of the angle that I'm approaching consolidation from the point of this presentation. I had two key things to call out. So one of them is when two companies merge, it's likely that they're both operating independently on different systems. Maybe for a period of time they'll continue to trade in silos and on their own systems with their own procedures, but at a point in time they're likely to come together to become one entity. So if we take the systems as the first example, migrating data from one system to another is no mean feat, and that could in itself create PI exposure there. If data is not migrated correctly, if data is missed, or crucial risk information isn't transferred over, then there's a potential E&O exposure there. A lot of you have called out business processes. Could look different for two entities. Bringing employees on that journey of consolidation and coming together. It's about getting everybody on the same page, making sure that there aren't any gaps in processes and that nothing's missed that could lead to a broader or PI exposure there. So thank you for those points. The next one is regulatory changes. Obviously, over the last couple of years, we've had IDD, we've had the most recent regulatory change that came into force in July of this year in the form of consumer duty. Now, regulation in itself isn't a bad thing. It's designed to protect the end consumer and businesses. However, the challenges from a insurance broker perspective is when these regulations come into play, then they have to incorporate them in as well as running their business, and they have to incorporate these into their day-to-day lives. So consumer duty is a new FCA principle requiring firms to document how they are delivering good outcomes for their customers. Again, You would hope that this was something that all insurance intermediaries were doing anyway and striving to do. But the onus now is on them to be able to document this and prove, if the regulator comes calling, that they have delivered the best or a good outcome for their customers. So there's an additional onus here that could give rise to claims or other challenges such as regulatory fines and investigations if they're deemed not to be complying with regulation. The next point I'm going to talk through on here is capacity, and in particular reduction in capacity. As I mentioned on the previous slide, we've recently gone through a hard market cycle, and what typically happens when the market hardens is capacity is reduced or pulled from the market. Probably a little bit unfair to insurance brokers, as they don't have any real control over capacity and what's available in the market. However, where it can be challenging and difficulties for them is if they're unable to source cover for their clients. It may be a renewal for a client and they can no longer cover for them for a particular area, or it may be that if they can place cover, it's severely restricted cover in comparison to what they've previously had, and often at a significantly higher premium. A topical example, and one that comes to my mind, is fire safety cover. So widely talked about, publicised, the Grenfell tragedy. It happened a few years ago. On the back of this, the market's responded by pulling capacity from the market. Clients, particular construction professionals, engineers, surveyors who previously had cover for fire safety claims, having to proceed with policies where there was no cover for such claims anymore. So it's a challenge for an insurance broker. And as I say, although they don't necessarily have control over capacity and the terms insurers are giving to them, they do have an onus to clearly articulate the changes in their cover to their clients, make sure they're aware that moving forward they won't have cover for these claims. Otherwise, if they don't do that and a claim arises, there could be an exposure to them because they didn't clearly detail what the policy covered clients for. Claims inflation and underinsurance, or I suppose inflation in general, is very topical at the moment. You only have to open any news outlet to see inflation's rising, cost of living crisis, etc., etc. But this example I want to call on in particular claims inflation and what that means from an insurance perspective. So the easiest example to give is probably where a insurance broker is placing a policy on a sums insured basis. So buildings, contents, business interruption insurance. If levels they're insured for are too low, at the point of claim, a insurer could decline the claim or proportionately reduce the amount that they pay in line with the level of underinsurance. Now, I just wanted to call out or quote a training session that I was in, a webinar similar to this earlier this week with our third-party legal provider who help us with our insurance brokers claims helpline, and who also help handle the claims once they come in and they're formally notified. So something that they said, and I'm just going to read it here because I noticed it down because I thought it was really relevant for this session, was failure to take into account inflation could lead to a claim for underinsurance. It may seem straightforward, but brokers are not surveyors. They, or at least the majority of them aren't, so they're not necessarily equipped to tell their clients what their sum insured would be. However, if we link back to insurance broker being a professional and giving guidance, they should be able to clearly articulate what's going on in the market and highlight the impacts of underinsurance and what this could mean for the clients in the future point of claim. If they don't give options. If they don't really articulate the risk of being underinsured, again, if an insurer repudiates the claim or reduces the amount they're going to pay, then it's likely that the client is going to seek the difference from the broker who placed the insurance from them in the first place. And then the final point on this slide is policy coverage. May seem like an obvious statement, but not all insurance policies cover the same thing. And as an insurance broker, it's vitally important that you understand the cover that you're placing and any notable exclusions or variances between one insurer's wording to another. Again, if you don't and you have a piece of business that you either pick up from another broker on a market that you don't use, or at renewal you're moving a client's insurance, it may be for a premium saving, it may be for any multitude of reasons. However, if you don't clearly explain the difference in the cover that you're moving them to, you could leave yourself open to a PI claim down the line. And to bring this to life, as I was preparing for this webinar and looking through claims examples, there was a topical claim that occurred recently where a client had so one of our insurance brokers had placed a personal lines home insurance policy on behalf of their client that included cover for jewellery and watches as well. There were some quite expensive items on there, and while their previous policy covered them for those items on a worldwide basis, the new policy had a care, custody and control clause on there, meaning that if their item wasn't on their person or deemed to be in their custody or control, the claim wouldn't be covered. And unfortunately, a situation arose where the insured had a item of jewellery taken from a hotel room. The insurer deemed that item wasn't in their care, custody and control, therefore declined to pay the claim. As the insurance broker hadn't clearly explained this difference, the claim was then redirected to the insurance broker. They looked to recoup the cost of the item that was stolen. So they are just 5 issues or areas that, as an insurance broker, I would be thinking about when thinking about my E&O exposure. Have you got any questions at this point? Anything before I move on to risk management that's come up, or anything you want me to explain in a little bit more detail?
Nothing come through as yet, Megan. There are a couple, but we can hold them till the end.
Perfect, thank you. So, moving on then. So, sorry if that slide felt a little bit heavy. Just to reiterate, it's not all doom and gloom. We're just thinking about worst case scenarios here and what could go wrong. So, risk management. This next section, it's not an exhaustive list of risk management techniques or tools, but it's just 3 key areas that if I was an insurance broker running my business, I'd be thinking about. And the flip side, as an underwriter insuring these risks, these are the things that point to moral hazard and risk mitigation. So these are the things that I look for, and also our proposal forms and questioning at underwriting stage are designed to pull out. So first off, we've got training. These are just a number of questions, again, that I would ask myself, or I do ask myself in the underwriting process. So first of all, are all staff receiving thorough induction programs and ongoing risk management training? Maybe most insurance brokers at some point or another will need to recruit into their business, whether that's through growth, natural attrition, or retirement. But it may be that you're bringing in somebody who has limited insurance knowledge at a junior level, who needs a thorough induction program and hand-holding through that process to make sure they are competent and up to speed and equipped to do their job. The flip side, changes in the market, changes in regulation do require ongoing training, CPD courses, such as this, just to keep people's kind of mind sharp and aware of anything that could potentially cause an issue down the line. Who is delivering the training? This is a question that I ask myself. So for larger insurance brokers, it may be that they have a dedicated learning and development team or resource focused on looking at all the learning and development and making sure that it's updated frequently, it's delivered to all employees in a timely fashion. If you're a smaller insurance broker and you may not have a dedicated L&D person or resources, then there are other areas you can look to. So this webinar provided via BIBA as an example, Chartered Insurance Institute has realms of webinars and learning material. And then there's also professional qualifications that you can encourage staff to do just to further develop their knowledge, but also keep them up to date with changes and things that are going on. And then the final point on training that I would just like to take a moment to consider is all training easily accessible? I think pre-pandemic, unless you were part-time or had working on a flexible working contract, the majority of roles in this area were office-based. It was probably easier to deliver face-to-face training to all employees. And I know in my experience, that was kind of the most common form of training. It was 8:30 to 9:30 every Tuesday morning, face-to-face training in the office. However, in the world that we live in now, there's a lot more hybrid working, so employees working from home. There may be people who are actually on full-time remote contracts. So I would spend some time thinking about how do we make sure that training is accessible to all. So are we able to offer e-learning? Do we record our training sessions? So if somebody not necessarily is working from home, but if they are on holiday and they miss the training, can they pick up at a later day and benefit from the same learnings as everyone else? The next point on this slide that I've called out is compliance. So again, speaking to consumer duty, it's not just how you're conducting your business, it's how you're recording and documenting how you're conducting your business. So just a few tips here. So internal controls, first and foremost, record keeping, and we'll see this as we go on throughout the presentation and look at specific claims examples. Are you documenting all your interactions with your clients? Email is a good way of doing this. Also, benefits of face-to-face meetings can sometimes be much more effective. It's just how are you following up on those conversations? Are you following up with an email to confirm everything that's discussed? Are you playing back everything, the demands and needs process? Are you saying, this is what you told me you needed? This is how I've understood it. Is that correct? This is what this cover provides you with. Are you happy that satisfies your need? Type of things. Recorded calls can be a great way of doing this. It's often easier to get in the moment, buying an agreement, again, by playing back what they've told you, but it's all there stored on a recorded call. So if down the line an issue does arise, then a dispute over what was discussed, we as an insurer and our claims team can just rely on that file, listen to the call and say, actually, this is a strong defence here, saying that you didn't tell them something, but we've got here a recorded call that you did, so we can rely on that as part of our defence. And then the final point I just want to touch on internal controls is peer reviews. So peer reviews, I think, can sometimes be seen as a way of checking up on people and calling people out, but actually it can be a really good risk management tool. It's not about finding a mistake and kind of pushing somebody or challenging them in front of their peers. It's all about understanding what's going on and how everybody, especially if they're working remotely or geographically split across the country, making sure that everybody is doing the right thing. And if there are any issues, they can be addressed at that point, and additional training can be offered and they can be corrected before it comes to a claim. Speaking to my team and the way we operate, we do monthly peer reviews. We review business that our colleagues or my colleagues in the team have written, and they review my business. In the event that something's identified, more often than not, because it's timely, it can be rectified without ever having to let the client or the insurer know. We can rectify it before it becomes an issue, which I think is a really good risk management tool. Again, if you have the capacity, do you have a dedicated conduct team or somebody who takes control of conduct and compliance within your organisation? With smaller insurance brokers, the directors will still be subject to SMCR regulations, so somebody will have to be accountable for this, but it's just knowing who that dedicated person is and knowing who to turn to and if you have any queries or if you identify that something's gone wrong. Clear lines of reporting. Again, everyone's human. There will be times when people make a mistake and things go wrong. It's what happens when something does go wrong. You don't want somebody being scared to or not knowing how to report it, so kind of pushing it under the rug and forgetting about it, hoping that it won't come to anything. All your employees know who to report a breach to or a potential mistake, and will they have the support through that to put right their mistake and rectify it before it becomes a larger issue. And then the final point is regular reporting. So it's all right reporting when something goes wrong, but what's done with the report? What is the process? Who reviews what's going wrong? Who identifies if it's a fundamental problem that all colleagues need training on? If there's a gap in processes that actually somebody's just overlooked, can we implement new processes to make sure that the same mistake doesn't happen again? Then the final point I want to touch on the risk management slide is MI, and in particular the quality of MI. Now, I think when people talk about MI, it's easy to jump to revenue MI. So how much new business have we written? What's our renewal retention? How many of our policies are we retaining? MI can actually include much more than this. So, and especially from a risk management perspective, I'd be thinking about cancellation reports on claims volumes, reports on claims data, or repudiated claims. Is there a frequent area where our clients are trying to make a claim and it's been declined by the insurer? Yes, it's because of this specific exclusion. Right, so shall we make sure that when we sell these policies in the future, we are clearly articulating this particular exclusion to clients so that we're not coming up against the same challenges over and over again? So yeah, the first question is, do you have access to quality data? And if you don't, then can you look at creating some reports that give you the data that you need to truly understand how your business is performing? And then next part is, how frequently is this data reviewed? You're well and good having the data, but if you don't do anything with it, then it's probably not going to help you or improve your business practices. I've popped here just a little comment around course correction versus reactive intervention. That's essentially everything that I've spoke to throughout this slide so far. So are we getting ahead of the problem? Are we identifying it quickly? Are we rectifying it before it becomes a bigger issue? Worst thing in the world is finding out about a gap in your process or a mistake, a failing in your system at the point of claim or at the point of complaint. It's much better to identify it early and get ahead of that and hopefully rectify it before it leads to exposure on your E&O book. So moving on now, just of time, we've got 30 minutes through, that's fine. Where are the claims coming from? So this data I'm going to share on this slide is specific to mum, just underwriting the claims that we've seen. As I said, we insure a large portion of insurance brokers in the UK, so hopefully it will be a reflection of how other insurance brokers' books perform as well. The main causations that we see are negligent advice, omission, and then complaints on the back of negligent advice or something not being as the client expected. And the second pie chart here is just notifications by line of business placed. So I don't want to dwell on this too long, but I thought it was just quite a good visual representation of the lines of business and where we've seen claims, and illustrates that it doesn't ultimately really matter about the type of business you're placing. If you make a mistake, if something goes wrong, then it could lead to a claim against you. And I would probably think that at mum we offer cover for COVID claims for our insurance broker customers, so that's probably the reason why the portion of claims on commercial insurance is higher. Obviously, as we move further away from COVID-19, I would probably anticipate this to be a more even split across the lines of business placed. So hopefully now on to the more exciting part of the conversation and really adding meat to the bones in terms of everything we've just discussed and where the claims come from. Got some examples of claims that we have dealt with at Manchester Underwriting and supported our brokers through. So the first one is a automatic renewal, didn't automatically renew. So I'm not going to ask you to show of hands or anything, but I think the majority of people you speak to or you work with will have fallen foul at some point of the system not doing what it said it was going to do, and ultimately leaving you with a challenge that you need to clear up. In this particular example, it was a fleet policy that insured placed on behalf of the client, and they told them that you need to worry about it. It'll just automatically renew unless you give us notice of cancellation. Unfortunately, the policy didn't automatically renew. And the first time that our insured or the client were made aware of this was when they tried to make a claim on their fleet policy for damage to one of their commercial vehicles. Luckily, it wasn't a huge claim. It was just a few £1,000s material damage. Ultimately, the insurer didn't pay the claim because at the time of loss there was no policy in place, and that loss fell on our insured, the insurance broker. So that was the claim. The broader impact is not only reputational damage for our insured, but could also indicate that there may be a wider problem. Just speaking back to the MI slide on what we just discussed on risk management, probably worthwhile at this point investigating, or if you are looking closely at your data, if there's a drop in renewal retention 1 month, probably worth investigating that. If one policy has failed to renew, the likelihood is that there could be other policies for whatever reason that haven't renewed. At that point, if you identify them before a claim comes in, you can then speak with the insurer, explain what's happened, and try and get the policies back in place without too much hassle or interference or disruption to your clients. So the claim example was a automatic renewal that went wrong. The second example I've got here is a claim that was declined due to a previous bankruptcy. So the context is our insured, the insurance broker, placed a property and business interruption policy on behalf of their client who ran a restaurant. Unfortunately, there was a fire at that restaurant, and when the client came to make the claim, the initial fact finds that the insurers undertook in relation to the claim, and that one of the directors had previously been made bankrupt. Therefore, they declined the claim, stating that had they known at the previous bankruptcy, that they never would have written this policy in the first place. However, after investigation, it was found that our insured, one of the account executives, had advised the client the material declaration only had to complete the declaration on behalf of themselves, not on behalf of the other directors. Therefore, the director that completed the form hadn't had a bankruptcy, and therefore the exposure then fell on our insurance broker because they'd given negligent advice. This was a much larger claim, a 6-figure claim settlement that again was now on our insured because they'd given negligent advice, which meant that the policy information hadn't been correct, and therefore the insurer was declining cover. Again, thinking about the broader impact of this, is there a training issue here? Do all employees need a refresher on advising clients how to fill out insurance declarations? Is this a wider issue? Are we reviewing policies each year at renewal to make sure that the material declarations are answered, and are we revisiting in a timely and frequent manner? Next claim is in relation to a complaint that was escalated to the Financial Ombudsman Service because a client was dissatisfied with their insurance broker. So to give you some context, the client was a products retailer. They sell products throughout the world, and unfortunately what had happened was one of the products that they sold had an issue in the manufacturing process and wasn't fit for purpose. They were no longer able to sell that product. However, they had a financial loss because they'd already purchased these products. The client then came to make a claim on their insurance policy, and unfortunately cover was declined because there was no cover in force. The challenge with this claim was that the client has said that they specifically discussed this scenario with the broker and raised it as a requirement of their insurance. It was something that they were worried about, and it was something that they wanted to ensure they were covered for in the event that it should arise. Insured said that this conversation never happened, which is why they didn't place the cover for them. However, there's no documentation, no recorded calls, and there's no evidence to confirm that this conversation happened or B never happened. So we're kind of in a tricky situation here because there's no proof, so there's no real defence for our insured. This one is still ongoing. But again, thinking to the broader impact and documentation, internal controls through the demands and needs process, the broker probably needs to sharpen up their processes and make sure that any conversations, any queries about coverage are documented clearly in the client file. If it's something that the policy doesn't cover, then make sure that they are making the client aware. As I say, still ongoing, but best case scenario for our insured is that the financial ombudsman rules in their favour. However, it's still not going to be a nice situation at this point. That the relationship between the client and our insured is probably unsalvageable. Final claims example here is in relation to underinsurance. So again, and something that we're hearing more and more of and seeing more and more notifications for due to claims inflation and clients being insured on the wrong basis. So this particular example was for our insured who placed a BI policy, a business interruption policy, on behalf of their client. They were a manufacturing business, so very location dependent. And unfortunately, after a flood at their premises, a loss adjuster went out to kind of gauge the damage and the time it would take to rectify the issue. And they advised that the indemnity period was insufficient due to delays in supply chains. So this client purchased business interruption on a 12-month basis. However, after the initial loss adjuster review, it was found that 12 months wasn't going to be sufficient to get the client back into the same position they were with the loss. Therefore, there would be an additional financial loss to them. This one was probably a little bit unlucky on the case of our behalf, of our insured, because they gave a 12-month indemnity period, which is what they were asked to do. However, the challenge here is, given their position and that they're meant to advise their clients, didn't speak to them and they didn't explain clearly the challenges in the market that could mean that their sums insured or their indemnity period was inadequate. Also, they failed to give options. So had the broker given options for a 12-month, 18-month or 24-month indemnity period, the client had chosen to go against their advice and go with the 12-month one, they probably would have had more of a defence on this claim. However, because no options were given, and the client is deemed to be the professional and the one qualified to give the advice here, it's looking likely that again this could be a substantial claim against our insured. Broader impact of underinsurance and this claim in particular is that it's an ongoing issue. So what we would advise and what we would look for is insurance brokers reviewing sums insured and indemnity periods at every opportunity. The business grows, turnover increases at renewal. It's not going to be the case that sums insured based on a survey from 5 years ago are still adequate to cover them. So the broker just needs to advise their clients of that, explain the impacts of underinsurance, offer them options and guidance and point them in the right direction to get adequate sums insured and make sure that they are accurately covered. Unfortunately, if something does happen at a point of claim, they've got adequate cover in place. And then finally, just a few minutes I just want to spend thinking about the future. and any potential risks or threats that we see coming on the horizon. It is a little bit of a crystal ball gazing exercise, as I don't know exactly what's going to happen, but based on notification trends and articles and data in the market, I just wanted to call out two areas first of all. So cyber and data insurance, and the second one, the picture here of the GP representing private medical insurance. So cyber in itself is quite a complex product. It's not been around as long as some of the traditional insurance policies. Also, the risk landscape changes quite frequently, which could prove problematic in the future if insurance brokers are increasing their cyber and data insurance placements without the necessary training or guidance to staff. A second one, as I say, private medical insurance. Again, post the pandemic, there's been an increased demand for this product. Individuals are choosing to purchase their own private medical insurance due to delays and backlogs with the National Health Service. And again, while we don't know what's going to happen here and play out, something that I would be thinking about is making sure that all staff are adequately trained in these products, especially private medical insurance. They're aware of all the notable exclusions, as this is going to be more emotive types of claims if they come in and they're repudiated. And also, I think the key here is to give clients options. Doesn't necessarily, the size of a business, it doesn't necessarily represent or tell of the risk, as with more traditional sums insured. If your building burns down, you need £500,000 to rebuild it. Cyber and data insurance, it could be that a business turning over just a few £1,000s a year has a six-figure claim. So the role of the insurance broker here is just to advise them of that and give them options, and ultimately let them decide which cover they deem to be adequate for their business. And then the final point is just to touch on the cost of living crisis or financial struggles in the UK at the moment. We know that during periods of economic downturn or financial difficulty, there'll likely be an increase in fraud, either people taking out fraudulent insurance policies or trying to make fraudulent claims. Again, the insurance brokers can't stop this from happening. They can't stop it, but what they can do is be on top of their admin, their documenting, record all interactions with the client and make sure that they've kind of dotted their I's, crossed their T's. So if what is suspected, they've got the evidence there to provide to insurers, and they're not leaving themselves open or exposed to any claims. Right, so that's all the content that I wanted to talk through with you today. Here's a repeat of the learning objectives that hopefully now you'll be more familiar with, and as I say, they will be available for you to copy and paste for CPD purposes at a later point. But I'm going to open up now for questions. So hopefully, Neil, you've had some questions in while I've been talking for what seems like an age.
Thank you so much. It was excellent. That really did open my eyes to the claims that can happen, certainly within the PI. One or two have got to dash, but obviously I've just got a couple of questions for Megan that have come in via the chat box. If you do have any further questions, please put them in the chat and we'll get to them as and when.
Absolutely, and if you've got anything that doesn't get covered off today, my contact details are here on the slide, so feel free to reach out to me directly.
Thanks, Meg. It's like you've done this before, you know. Amazing. Thank you. Here we go. So there's been a question coming. It's more of a comment, really. Are you seeing an impact from the increased inflation rates on claims?
So the short answer is yes, no. So from a professional indemnity, claims inflation, with the examples, is more easily linked to sums insured policies or policies with an indemnity period where there's a clear insurance identified at the point of claim. we write professional indemnity insurance, or my team does in particular. So we're not seeing as much of an impact. However, a large portion of our book is construction professionals. So as well as insurance brokers, we write professional indemnity for design and construct business, architects, surveyors, and the like. So where we are seeing claims, we are reserving more prudently to take into account that if material damage has occurred or construction is required to put the client back into the same position, it's probably going to cost us more in the long run. Also, just from legal costs, due to inflation in general, we're observing higher because you will ultimately have to pay more in the event that that claim develops.
Thank you. Thank you. There was one quick question with regards to agencies and how do you get a TOBA opened up? So there's no minimum support levels because of the BIBA relationship, but how would somebody or a brokerage open an agency with you?
So just contact us directly. So we are, as you can see now, we're part of Penn. So before where we had a more restricted number of brokers that we work with, we're now open to work with all brokers that have an agency with Penn Underwriting.
Great.
So there's a few thousand in there. But yeah, if you want to open a TOBA with us or a business, then just get in touch and we can have a discussion.
Okay, thank you. As you've probably seen pop up on your screen, there's a couple more come through. Alan's asked us, seeing more onerous terms, warranties being imposed by insurers. Mm-hmm. Some are incredible in their requirements. Is this reflected in claims you receive?
We have seen more onerous warranties being imposed by insurers requirements in the claims you receive. Yes, so yes, it will be. I can't think of any specific examples off the top, but where insurers are putting more strict requirements on their policies, if our insurance brokers fail to clearly explain that, then ultimately that would potentially open up an E&O exposure for our brokers, which is so vitally important when they're documenting risk, when they're articulating what the policy covers, that they are calling out those warranties and terms. Because if they don't, and a claim comes in and is ultimately repudiated by the end insurer, then obviously the client's not going to be happy with that and look to recoup the costs from their insurance broker.
Oh, thank you. And then there was the last one. Cheers, Alan. Thanks for the question.
Thank you. Yes, very good.
From Shane. Have you seen that one there? So I'll read it out for the audience. It says, from Mum's perspective, do you think brokers need to be providing the cost options for different scenarios? Or it's sufficient to make clients aware that we think their indemnity period, for example, is insufficient, and to contact us if they would like to look at different options?
I think it's, where possible, it's always better to do the former. So give them the options and give them the cost implications of the different scenarios. I know from our perspective, most of the time it's easier when you're obtaining a quote from an insurer to ask for multiple options rather than having to go back and forth. I think as well it comes down to the element of advice and how complex that risk is and how well placed the client is to make that decision. I think as a bare minimum, you should be offering to explore the other options. But where possible, if you just give them in black and white and then they decline that option, then you've to a point done all that you can, and you've protected yourself from potential future claims, because you can clearly say, gave you 3 options and you came back to me and said you went with this shortest indemnity period because it was the cheapest. We advise you it might not necessarily be sufficient, but whereas if you're saying here's the 12 months, you're kind of already given a recommendation before, because you're deeming that to be the most appropriate. So I'd say where possible to give thorough options, and which includes the cost implications of each of them.
Thanks, Megan. That's really good. Thanks for the question, Shane. Very kind. Okay, well, I said to you, didn't I, when we were doing our test yesterday, sometimes you might not get many questions from the floor because you've covered it all. You really did. That was just a fantastic presentation. So I'm very grateful.
Thank you very much.
Guys, just a wrap up, really. Obviously, any more questions from the floor, or if you want to just send a little note to everyone, and obviously Megan will see your comments. The one we always like to see. Excellent. So we like that one. We like that one. All the comments coming through now. Thank you, guys. That's really kind of you.
Well, thank you.
Look at that. Look at that.
I might even come back and do another one.
You can do it all again now. Thank you. That's really kind. Is there anything further you would like to add before we finish for today?
No, I wouldn't. I'd just like to thank everyone again for their time. And obviously, if you've got any questions, my contact details are there. So get in touch.
You've nailed it. Absolutely nailed it, Megan. Thank you so much. Guys, great to see you all again. Bill just said it held my concentration to think about how we work. It held mine as well. Sometimes I drift off thinking, oh, goodness me, I've got to do an email or two. But this one I was fully engaged with it, Megan. So well done. A big thank you to you for hosting and putting the event on. Out there in audience land, great to see you all again, guys. Thank you for your attention and attendance. Lynn, just to answer that question for you, we have recorded the session and you will be able to see it online a little bit later in the day once I send the recording over to the office for them to upload. Oh, last one. You've seen that one come in there. In line with regulatory guidelines and best practice, should brokers be recommending other policy limits to a client? Or is it better for the broker to leave the clients to set their own limits?
I think that question really depends on the type of product being placed. I think where there's an obvious, again, to link it back to some insured, where there's an obvious in mind, where it's professional indemnity, for an example, I think the best thing to do is give options, talk about the client about what could be the impact going wrong. If they have a £1 million contract that's limited to, they limit their liability to the value of the contract, and it's probably reasonable to assume that 1 million is going to be sufficient. If it's kind of open-ended, if they're working on broader projects where the end claim could be much higher, then with that. But yeah, it's
just reviewing.
I think always give the options.
Yeah, absolutely. Yeah. Thank you. Someone, thanks for the question. I'm glad you got that in before we press the big X. Please, thank you. You're more than welcome. Well done. Thank you, Megan. Guys, right, what are we on? 7 minutes to 12, so I presume it's lunchtime for most. I've got to jump on a Merseyside committee meeting now. So, Megan, it's been a pleasure meeting you, and thank you again for everything you've done. Guys in audience world, hello. Lovely to see you, and we'll see you on the next one. Take care, guys. See you soon. All the best.
Thank you so much.
Bye. Bye.